Welcome to TFN Smart Trading. I'm Laura Cadden. Many analysts are calling for a quick recovery from the current U.S. recession. That's if they even acknowledge that we're indeed in one. The economy has managed to squeak by with a 0.6% growth rate over the past 2 years. How does this outlook fit into the picture of increased foreclosures, falling home prices, rising unemployment, and record food, and fuel prices? I've invited Eric Roseman, Investment Director and Editor of the Commodity Trend Alert, to get his perspective. Welcome to the show, Eric.
Thanks. Great to be here.
So what do you think about the U.S. economy? What's happening?
I think we're transitioning from a rapidly growing economy in the late 90s, first part of this decade, into a slowing, muddle-through economy that's going to take probably about several years of very difficult transitioning, getting rid of leveraged debt, the housing boom, which is now a bust. These things historically take a long time to deflate. And the Fed will do everything it can to print more credit, expand the monetary supply, and it's going to be a very tough environment, I think.
What do you think about U.S. interest rates? Where are they heading?
Lower for the short term. I think interest rates, the Fed funds rate currently at about 2 will go probably about 1, maybe half a point. Could go as low as 0 depending on how bad the housing crisis gets. But there's no sight to the end of the housing bust, and foreclosures are still sitting at record highs. There's a lot of supply, a lot of inventory of existing and new homes. That's a bad sign. It's a very ominous sign. So the consumer's struggling, and throw high energy prices, high food, deflation and unemployment. As that rate rises and the housing prices, it's going to be pretty nasty. Rates are going to come down first, and then eventually they'll go back up, but much longer.
What do you think investors should do in the U.S.?
Diversify. I think you definitely got to do that. That's always a good thing to do. I think you should be looking still at some raw materials still offer some excellent diversification, namely the grains. I'd be looking at livestock, which is exceptionally cheap, gold, platinum, which are now in supply deficits, and you can definitely still look at some foreign currencies, although I'd be very hesitant to sell the dollar here. It's had a huge drop the last 6.5 years. It's very, very cheap.
What about metals?
The metals, again, silver neutral, palladium neutral to bearish, but very bullish on gold, very bullish on platinum, which are in supply deficit now, and industrial metals, very bearish. There's a lot. You've had a huge move in things like copper, lead, tin, nickel, and things like that, so I'd avoid them now.
Now, with the gold, there's been a downward pressure of late on gold prices. What do you think about that? You think that's not going to continue?
It's normal. It's a correction. The dollar, look, I mean, the dollar and gold have historically have a negative or inverse correlation to one another. So when you see the dollar soaring like it did the second half of the 1990s, gold prices took a bath. Conversely, now the dollar is at an all-time low or near all-time lows. Gold prices are at all-time highs. But it's more than that. More than the dollar being weak, it's supply and demand. The fact is that there is now, for the last almost 18 months, borderline to net supply deficits for gold. And that determines the price for any commodity, is supply and demand. More than the dollar, more than interest rates, it is supply and demand. So gold has a long way to run. I think it'll probably at least double from these levels. Inflation adjusted from its high in 1980 probably should be around 2150 right now. So I think it'll go way beyond that before this is over.
Do you have a specific recommendation for how people could play on that?
Yes, I like the metal, and I like one of the leading gold producers. So for the latter, if you want to buy a great global gold producer, my favorite is Goldcorp. It has assets in safe countries, namely in Canada, the U.S., some foreign countries that don't nationalize mining properties. Great balance sheet, 84% increase in its first quarter earnings. Average production cost, the lowest in the industry, only at $240 an ounce versus about $880, $890 an ounce for gold right now. Those are great margins, and they're getting it fatter. And super management with Ian Telfer. So that's one way to play it. Symbol is GG on the New York Stock Exchange. And to buy the metal, you can do it, I think, through ETFs or exchange-traded funds. You can buy the COMEX Gold Shares. Symbol is IAU on New York. Or Street Tracks Gold Trust, which is GLD. Very easy to own, very, very liquid, and you buy a percentage of gold.
And very great information. Thank you so very much.
Thanks for having me. It's a pleasure.
For more information about Eric's research service, Commodity Trend Alert, go to www.commoditytrendalert.com. To read a transcript of this interview, go to the Gold and Resources section of the todaysfinancialnews.com homepage. For Eric Roseman and TFN, I'm Laura Cadden.
Oil prices could realistically as high as $73 to $74 per barrel this summer. It all rose